In this video, we are covering what every Canadian loves to invest in. Yes, that's right. If you guessed it, it's the banks. We'll be looking at various types of ETFs that you can add financial institutions here in Canada into your portfolio. We'll look at some equal weight bank ETFs. We'll look at the covered call ETFs, and then stay tuned to the end. We'll look at my favorite way to play this in my portfolio. But if this is your first time here, my name's Nick and welcome to Ways to Wealth. We are going to start out by giving a little bit of a general landscape of the financial situation here in Canada. And the first part that I can point out is that the TSX composite, the index here in Canada, is made up of about 30% of financial institutions. That's why it's Canada's favorite. It's something that has been paying dividends consistently. It's something that is a staple in all of our portfolios. Now, obviously, when we look at ETFs, the reason that we love them is for diversification. We don't have to go and buy just one bank. And when we look at how much it would be to buy all the individual banks, maybe buying in one ETF may be more efficient for your size of portfolio. The first section of ETFs that we are going to look at today are equal weight bank ETFs. And if you're not sure with what that means, we're going to break it down right now. We are currently looking at the holdings of ZEB.TO. It's a BMO product, and what we can see is that 100% of its assets are in the big six banks, and they're split pretty much evenly. So you're looking between 15 to 17% of each individual bank, and this really takes away the risk of holding on to one that is an underperformer or not having one in your portfolio that happens to outperform the rest. So this is a pretty strategic way to add this into your portfolio, to add exposure into the big six banks, but not having to pick a favorite in the race. There is three that I've been able to find that trade on the TSX. I put them into a Yahoo chart here just to see a comparison. This dates back 5 years, and we can see two of the products are relatively the same performance over a long run period. Now keep in mind, this does not take into account dividends, and there is a special reason that I've announced that, and that's because there happens to be an outperformer, and that is WB.TO. And the reason that it's outperforming, when we look at the product sheet, we can see here that it is a total return index. And the advantage comes is that there's tax efficiency, especially if you're holding this outside of a registered account, meaning that you'll pay tax on any distributions. Well, this ETF has none, and that makes it, very advantageous on a tax presence. So if you wanted to get exposure into financials or the big six banks in a non-registered account, this may be the product for you. And when I put all of these names together in the Excel spreadsheet here, we get an indication of what the stock price is. We can see what the dividend yield is. Just to repeat, that HEWB does not have any dividend yield, and it's got a pretty competitive MER, meaning that you're not paying a lot to the ETF provider. And the performance year to date has been relatively the same. Again, this does not take into account any dividends that are paid. So if you want to add equal weight banks, you don't want to pick a winner, you just want to get exposure into the financial institutions, this may be the best for you. The next section of ETFs that we're going to cover are covered call ETFs. We have touched on this topic so much because covered calls become super important in a stagnant market, in a market that's moving sideways. Now, in a market that's moving sideways, what the covered calls do is they provide more yield. So we'll touch on yield in a bit, but if we look at these two products here in Yahoo Finance, we can see that they perform relatively the same. So there may not be a winner, there may be a preferred provider that you prefer working with. So make sure to do some more homework on these, especially if you like yield in your portfolio. If you need that income, these may be the best for you. But when we look at the Excel spreadsheet here, we can see that there's two providers, CI Financial and a BMO covered call product. So pause the screen if you want to take a look at some of these ticker names. But we can see the dividend yields are relatively the same, just north of 7%. MERs are not too far off as well, and we can see the year-to-date performance. So I don't think that you could go too wrong with any of these products. The important point to note is that obviously these are for people that need yield or income into their portfolios, and then additionally they work really well in a stagnant market because you're able to get some return out of the market. But if the market does turn bullish, then these products will lag some of the other ones that we've covered today. The last grouping of ETFs, other notables, these are ones that don't really fall into a grouping of ETFs, but some that I thought would bring to the forefront, especially if some pique your interest. But we're going to be covering two in detail, ones that I find really interesting. But let's just take a look here at some of the different products. You know, we have our iShares, Hamilton's, BMOs, and the first thing that I gravitate when I look at this list is what the dividend yield is paying. It gives me an indication of how things are going and obviously how it's performed year to date. I know it's a small sample size, but make sure when you're looking through some of these names to see what's best for your portfolio, that you're doing more homework, you're going into the ETF product sheets to see what may fit your portfolio best. But with that being said, one of the ones that stands out to me on this list is something called the Hamilton Bank Mean Reversion Index ETF, HCA.TO, on the Toronto Stock Exchange. And the reason that this stands out to me is the term mean reversion. So what does that mean? We'll take a look here at the ETF's website to learn a little bit more about what mean reversion means. So it is one of the most popular themes in Canadian bank investing, given that individual Canadian banks have tended to perform similarly over time. So it attempts to take advantage of these tendencies by rebalancing the portfolio quarterly and investing 80% of the portfolio in the three banks which have underperformed. The rest, the 20%, is in the three banks that has outperformed. So this is a little bit different than the equal bank. What this is saying, what this basically theory is that traditionally there will be banks that underperform. We look at Bank of Nova Scotia or CIBC right now, and they are not performing like some of the other banks have performed. And what they do is basically over time, they should catch up. So that's what this ETF is doing, is it's betting that some of the underperformers, some of the laggards, some of the ones that just haven't kept up will eventually keep up and maybe surpass. So they place a little bit more of a bet on them. And obviously when the stock price comes down, so too will the dividends increase. And that's why it's able to pay a 5% dividend yield. So this one's super interesting. They do all the work in the background. You get exposure into financials, but you're betting on the underperformers to catch up. And when we take a look at the holdings here, we can see that CIBC is at 27% of the portfolio, TD 26%, and then obviously Bank of Nova Scotia at 25%, and then we have the remaining three that are trending at under 7%. So this is definitely something that is very interesting to me, especially because this is a way that people do play it. Now, with that being said, my personal favorite, the way that I play this in my portfolio is HCAL. And this product is a little bit different because it pays a higher yield. Now, when we talk about my personal preference, my goal with the TFSA is that I create a machine for me when I retire that spits out cash. So for some people, the TFSA may be an opportunity to invest in more growthier stocks. For me, my personal way that I play my TFSA is to garnish yield. So I really like the HCAL because when we look at the website here, it's paying almost a 7% dividend yield. And the way that this fund is built is that it's designed to track 1.25% of the returns of this mean reversion index. And it's got what that 2.5 is 25% in moderate leverage. And it does not use derivatives. So it is basing this ETF off of its predecessor, the HCA.TO, but it gives you a little bit of leverage. And obviously the yield looks great. For a quick comparison, let's throw them both into Yahoo Finance. And we can see here that the performance is relatively the same. There are periods in a bull market where the leverage does help out the HCAL product. But realistically, it depends on what your preference is. And I think that HCal is the pick for me, but depending on obviously all the names that we've covered today, you have to analyze what is best for yourself. And if you like this video, make sure to go check out my other ETF videos. You can look at maybe some of the top dividend performers, or maybe you like that high interest savings in an ETF format. So click there for that. I hope you all have a great week in the markets. Happy trading.